for the whole country. That's pretty interesting. Also, there's a measure called Trueflation that takes 11 different data readings into account. This is a U.S. measure that is used across the country, and it is recorded every day on a year-over-year basis. We can get this every day, and you can find it online. On a year-over-year basis, it is 2%. Brazil, Russia, India, and other major economic partners are thinking about forming a coalition. South Africa and China are also thinking about a common currency. There is talk in economic diplomacy about this being a dangerous idea, but the committee hasn't decided yet. Recent events show that the BRICS are de-dollarizing, which means that these countries are slowly adopting their own currencies instead of diverging toward a single currency. Common currencies could change the way countries deal with each other, but they may not be as close as recent rumors suggest. Brick-and-mortar bank NDB recently rejected that the group would start working on a single currency right away. Watch the movie and listen to Cathie Wood talk about economic signs of global economic change, market signals, and bitcoins as a way to protect against inflation. So let's start with economic policy. We are about to enter election year, which means that there will probably be gridlock. This is a good thing because it means that there won't be much to shock the markets with in terms of fiscal policy over the next year. This is also good for monetary policy because the Fed is still in charge. Interestingly, at all money supply is down roughly 5% on a year-over-year basis. Haven't heard a word out of the Fed on it. Maybe you have, but I haven't. It is still very focused on this, on inflation and employment. Now employment, we had so many indicators in the last week or so that there was something for everyone, bulls and bears. So today we got the non-farm payroll. It was below expectations at 209,000, expectations for 230, but the important point was downward revisions, 110,000 jobs revised away over the last few months, so that made this quite a weak report from unemployment point of view. But if you looked at average hourly earnings, they were a little better than expected. The Fed may not have like that, and average work week was a little better than expected, so those probably all netted out to something a little weaker, not a lot weaker than expected. Now we got all kinds of indicators. We got the ADP on Wednesday employment, which was almost 500,000. And of course, that roiled the market. In today's report, household employment, as you know, we focus on that because it captures more of the small businesses that are very important at turning points. In terms of a leading indicator, last month, those jobs were down negative 310,000, but this month they bounced back, not all the way, but 273. In the report today, a temporary employment was very weak, and I rarely see it that weak, so I took note of that. And we also got at the job openings report this week, and the number of job openings dropped by about 500,000. So again, as I said, something for everyone, including the Fed. The Fed seems to want to pay attention to the stronger numbers. So that is the employment side. On the inflation side, we see a year ago, the commodity prices started falling pretty precipitously, and so now we're coming up against the comparison against that drop. So commodity prices, which had been down on a year-over-year basis by 20 to 30%, are now down roughly 12%. So again, we're comparing against declines last year now. If you look at the Bloomberg Commodity Price Index, it is still in a downtrend, so that is a leading indicator for inflation. The PPI reported this past month was up 1.1% on a year-over-year basis. So the Fed has a 2% target on a year-over-year basis. We've got to leading indicators that are well below that commodity prices, and the PPI up only 1.1. If you look at the retail sales deflator, this is a number you kind of have to back into, and not many people pay attention to it. But it does belong to the retail sales report, which is a little more goods-oriented than services-oriented, but that is up only 0.2% on a year-over-year basis. And that is a consumer inflation measure. We do have the CPI. The last print was 0.1% month to month, so very good, well-behaved month to month, but still up 4% on a year-over-year basis now this next month. So for June, and this report I think will be out next week. The comparison against a year ago was month to month. The CPI from May to June a year ago went up 1.2%. So if we see the CPI up only 0.2% this month, month to month, then we will be dropping off a full percentage point, and that will take the year-over-year down from 4% to 3%. I know that's maybe a lot to digest right now. A lot of big surprises have happened this year. We thought that 2012 would last longer than expected because demand was so low. When demand stabilized, it was even harder to find new supply, which caused inventory to drop and home prices to stay the same. But mortgage rates seem to be going up again, and everyone is aware of the problems this causes with affordability. What will it take for the inventory of homes to build for the second half of the year? If mortgage rates go up, demand will slow and inventory will build up like it did in September and October of last year. If mortgage rates stay below 7% or ease, lower homebuyer demand will rise and available inventory will shrink. This is important to keep in mind because common sense says that lower mortgage rates will bring new homes to the market, but data shows that lower rates actually decrease inventory. See what Cathie Wood thinks about the market signs by watching the movies. At the last meeting, everyone agreed that the Fed funds rate should go up again, even though it stayed the same the previous time. They thought that inflation would cause more increases in the coming months, so I don't know how they got to this unanimous vote. I think that the newest member, Us.Thanks, is stirring things up a bit but isn't willing to vote against the chairman in the end. Okay, so that's inflation and employment, which is what the Fed seems to care about, and both of the metrics they use are lagging indicators, which really makes no sense to me. Our confidence that we're moving into a deflationary environment is increasing by the month, especially because the Fed is railing against inflation when it is already coming down quite significantly. You know, it's interesting to listen to reports like cost goes in and Home Depot task. Cost goes basically saying, okay, we're going to have to clear inventory by cutting prices. They just come right out and say it. But the Fed's not incorporating those sorts of variables into its analysis now. Just to the backdrop, though, away from these numbers, we're seeing rising bankruptcies, and a lot of the reason for this is because a lot of businesses take loans out on a floating rate basis. In fact, those are the only kinds of loans they can get, and the rates have gone up so much, 21-fold if you look at the Fed funds rate and in a little more than a year, and a lot of businesses just cannot afford these loans anymore, and you're seeing the same with commercial real estate. Strategic defaults left, right, and center just can't put up with the interest rate increases and the empty office buildings. One of my dear friends, a doctor in one of the best parts of New York City, Madison Avenue, Midtown, she's being evicted, and so is everyone else in the building because it's only half full, and this used to be prime property. I don't think that's just true for New York. I think the same thing could happen in many other big places around the world, maybe even in smaller ones, since the regional bank is involved. There are problems out there. Where else would we expect to see problems related to the huge rise in interest rates in such a short time? Even though Bitcoin is close to $30,000 and other cryptocurrencies are trading cautiously with hopes of big changes in the near future, the SEC received multiple spot Bitcoin exchange-traded fund applications in late June. Similar applications have been turned down before. The only difference is which institutions applied, with BlackRock and Fidelity leading the market needs. The fact that new ETF applications and continued investment in tokenized asset applications show that the crypto-native sector is not leading the future. TradeFi appears to recognize the crypto asset market hunger and potential beyond speculation. A Bitcoin ETF will affect crypto trading, which is clear and hard to understand spot ETF products, especially those